So, like I said, today we are going to be looking at CVP analysis. It's a practical topic that you cannot avoid not to understand the concept. Uh, one importance or one of the objectives, there are four key objectives of CVP analysis. One is to determine the units required for a company to break even. When a company wants to break even, that simply means is that the company is expected not to make profits or to make loss. That is break even. Your total revenue will be equal to your total cost. Then again, the company may want to determine, okay, how much sales are we going to make in the market in this period for us to be able to break even? Now, it is also possible that the company may want to earn a targeted profit. Therefore, how many units or how many sales value are we going uh, to make for us to be able to achieve a targeted profit before tax? So these are practicable things that you need to take into consideration, be it a manufacturing company, even a service company. Because when a company wants to source for funds, maybe there's a project that the company wants to execute, but the financial capacity is not there. So the company may need to approach investor or banker to say, please, I need so much money to finance a project. So one of the requirements would be that the company should provide um, a financial summary of the business, okay? This may come under business plan or under feasibility study reports. So in the feasibility study report or in the business plan, the company would need to prepare what is called 1 year, 2 years, 3 years, or 5 year financial summary that will dictate how the companies will be able to generate revenue and the likely expenses that the company will incur, or the investor will want to see whether the company has the capacity to pay the interest expense from the loan. All right. Not only that, the potential investor will want to know whether the company is profitable. Okay, maybe the company is a profitable venture. However, again, in the business plan, the company will need to indicate the worst case scenario. What if you are unable to make profits? What is the worst case scenario? So you need to prepare a kind of break-even analysis that will show to the prospective investor that, okay, worst case scenario, I should be able to break even. If I'm unable to make profit, I should be able to, to recover all my expenses and all of that. And that's what I said, that the CVP analysis, or what is also known as break-even analysis, is a practicable kind of concept that you need to take into consideration. All right. Therefore, what do you then understand by CVP? You will remember when we had short-term decisions, I mentioned to you that marginal costing concepts is a technique that is designed to aid managerial decision. And I listed about 8 or 9 areas in which you can apply marginal costing technique to aid managerial decision. One of the areas that I mentioned to you is CVP analysis. CVP analysis. Therefore, what do you then understand by cost volume profit analysis? Simply put, cost volume analysis involves the application of marginal costing technique to establish a relationship between cost, volume, and profit at different activity level in making managerial decision. All right. So you want to know what is the relationship between cost, units, and also units is the same thing as volume, okay? And also profits at different activity level, okay? So in order to aid managerial decision. The CVP analysis, cost volume analysis, is also known as break-even analysis. And you know that when you talk about break-even, it's simply a point whereby total revenue will equal or will equate total cost. A point of no gain, no loss. That is what is called break-even analysis, which means that any point above the break-even analysis, it means that the company will be profitable. The company will earn profit. And then any point below the break-even point, it means that the company is going to incur loss. Okay? So that is break-even point or break-even analysis. And then, of course, the CVP analysis relies heavily on the behavioral classification of cost, which states that a cost item must be capable of being classified as either variable or fixed cost. So these are the little introduction as per CVP analysis. Then let's talk about contribution margin. Let's talk about contribution margin. Contribution margin simply means the difference between the selling price and then the variable cost per unit, or the difference between the total sales and total variable cost. You can also say contribution margin is the summation of profits and fixed costs. Okay, so that is for that. Then what do you also understand by contribution margin ratio? The contribution margin ratio, also known as profit volume ratio, represents, okay, the ratio of contribution to sales. I repeat, the contribution margin ratio is also known as profit volume ratio. It is the ratio of contribution to sales, the ratio of contribution to sales. Therefore, how do you then calculate contribution margin? How do you calculate contribution margin? The contribution margin, of course, we have done it previously, but here is CVP, so it's still the same thing. How do you calculate contribution margin? The contribution margin can be calculated as follows, depending on the information available, okay? You can calculate contribution margin, okay, as selling price, okay, selling price minus variable cost per unit. You can also calculate contribution margin as total sales minus total variable cost, okay? Not only that, for you to determine contribution, in case you are not given sales or you are not given selling price, then but if you are given profit, you are also given fixed cost. Therefore, contribution margin is fixed cost plus profit. Okay. Remember, when we did operating statement, marginal costing, marginal and absorption costing, I mentioned to you then that marginal costing concept is an accounting system whereby the fixed costs incurred are written off fully from the aggregate contribution. Of course. So, and that's why whenever you want to determine contribution and you don't have sales value or selling price, just add up the fixed cost plus profits. So it will give you contribution. So how do you then calculate contribution margin ratio? I told you that contribution margin ratio is the ratio of contribution to sales, all right? There are several ways in which you can calculate your contribution margin ratio, depending on the information available. If in the question, you can see the total contribution. If you are given total contribution, then contribution divided by sales will give you the contribution margin ratio, okay? But if in the question we are given selling price, you're also given variable cost, and you want to determine contribution margin ratio. Therefore, contribution per unit divided by selling price will give you contribution margin ratio. That is this one. Then, if in the question, okay, you are given total sales, you also have total variable costs. Therefore, the total sales minus total variable cost will give you total contribution. Therefore, total contribution divided by total sales will give me the contribution margin ratio. Then it is also possible in the question, if you are not given sales value, you are not given selling price, but in the question, of course, you have sales, but you don't have variable cost. You have sales in the question, but you don't have variable cost. But you are given fixed cost, you are also given profit. Therefore, profit plus fixed cost divided by total sales will give you contribution margin ratio. So you have to master all these formulas because you don't know what information will be available, okay, on the day. So that's why you have to take your time to review all the relevant formulas in that. So these are the basic things you need to understand. There's one more calculations that we are going to talk about, which has to do with the objectives of CVP analysis, okay? However, there are some theoretical areas of this scope that I want you to go ahead and study. You have to write it in your own notes. Examiner can ask you, what are the areas of application of CVP analysis? Please go and form a note on that. I don't want to be talking story in class. We have a lot to do tonight. Then again, go and form a note in summary form. Okay, form a note on limitation of CVP. All right, on limitation of CVP. Then there's one more thing I need you to do for me. Then go and form a note on the underlying factors. Here's the person distracting my class. So again, so go and form a note on those areas that I've highlighted for you. Muiba, you are distracting my class. Mute yourself. So now, earlier on, I mentioned the objectives of CVP analysis in part of my introduction of this topic. Now, there are 4 key objectives that CVP analysis wants to achieve. One objective is to determine the number of units required to break even. Like I said, it is CVP analysis, break-even analysis is practical. Company may want to know how many units are we going to produce this year for us to be able to break even. You don't want to make profits. You also don't want to make loss. Therefore, how many units are you going to produce as a company? So company may want to know how many units are we going to produce in this current year for us to be able to break even. That is one objective. Again, the second objective is to determine the sales value required to break even. Okay, we want to sell in the coming year. How many are we going to sell? How much sales are we going to make in the market for us to be able to break even? That is also an objective, all right? Then another objective would be that the company may want to earn a targeted profit. Therefore, one of the objectives of CVP analysis is to determine the units required to achieve a targeted or intended or predetermined profit for the organization. All right, you want to determine the number of units required to achieve a targeted profit. Then the last objective of CVP analysis is to determine the sales value required, okay, by an organization to earn an intended or predetermined profit. So these are the 4 key objectives of CVP analysis, and each of them has its own underlying formulas that you are going to use, okay? Because when you want to determine these break-even points, these are the things you are going to be, the formula attached to each objective is what you are going to use, depending on the requirements of the question, okay? Now, for example, for the first one says that you should determine the units required to break even. All right. When you want to determine the units required to break even, what formulas are you supposed to use to do that? Very simple. I would then say, excuse me, my pen is not connecting. Okay, right. So if I want to calculate, for example, the units required to break even, in that case, I would then say break even point in units equal to the fixed cost divided by contribution margin per unit. Okay? Fixed cost divided by contribution margin per unit will give me the number of units required to break even. Remember, for an organization to be able to earn a profit, you are going to deduct the fixed cost from your contribution margin. And that's why when you are calculating your break-even point, you'll be making reference to fixed cost and the contribution margin or contribution margin ratio, depending on whether you want to calculate break-even points in unit or break-even points in naira. Okay? So, therefore, for you to be able to determine the break-even point in this first objective, okay? In that first objective, which says to determine the units required to break even, this is the formula that you're expected to use to calculate the break-even point in units for the company, the number of units to be produced for the company to be able to break even. The second one, we state that to determine the sales value required to break even, all right? In this case, I would then say break-even points in naira will be equal to the fixed cost divided by contribution margin ratio, okay? Anytime you are referring to break-even points in units, anytime you are referring to break-even point in units, the denominator must be contribution margin per unit. Anytime you are referring to break-even points in naira, the denominator must be contribution margin ratio or profit volume ratio. Now, the third objective is to determine the units required to earn a targeted profit. So when you want to determine the units required to achieve or to earn a targeted profit, then the break-even point in units will be calculated as fixed cost plus targeted profit before tax divided by 1 minus tax rates, or divided by, let me give a space, or divide by contribution margin per unit. Okay, so this is the formula that you are going to use whenever you want to determine the units required to earn a targeted profit. Okay, the last objective is to determine the amount of sales required to earn or to achieve a targeted profit. So in this one too, I would then say break-even points in naira to achieve a targeted profit before tax. Number of sales required to achieve a targeted profit before tax would then be equal to fixed cost plus targeted profits before tax divided by, no need to, I'm looking at the position whereby you are given profit after tax. I've forgotten this is profit before tax. So there is no need for this. No need for that. Okay, let me rewrite this. Okay, targeted profit before tax divided by CMU. I will explain that one later. Okay, then this one divided by CMR. Remember what I told you. Each time you want to calculate break-even point in naira, it must be CMR. Anytime you want to calculate break-even point in units, your denominator must be CMU. So these are the 4 key formulas that you are going to use whenever you want to calculate your break-even analysis or break-even points. Okay, whenever you want to calculate your break-even point. There are 2 more formulas which I'm going to give to you. I've already written it and I clean it up, but let me just explain. Now, at all time, the targeted profit to earn must be profit before tax. But in some instances, examiner may give to you profit after tax. You don't use profit after tax to calculate break-even points. Therefore, you need to convert the profit after tax to profit before tax. Therefore, if you're asked to determine break-even points to achieve break-even points, when you're asked to determine the number of units to achieve a targeted profit, okay, a targeted profit after tax of so much, then in that case, you need to the formula that you are going to use would then be, for example, I would then say break even point in units equal to fixed cost plus, because examiner has given me profits after tax. You don't use profit after tax to calculate break-even point. The targeted profit to end must be profit before tax. So if profit after tax is given to you, you must convert it to profit before tax. So in this case, I would then say targeted profit after tax divided by 1 minus tax. So once I do this, it means that I've converted the profit after tax to profit before tax. Once I divide targeted profit after tax by 1 minus tax rates, it means that I've converted it to profit before tax. Then I will now divide by the contribution margin per unit. So this is the formula that you are going to use to calculate break-even points in units break-even points in units to earn a targeted profit after tax. This is how to do it. Then the last one, if you are asked to calculate sales value required to earn a targeted profit after tax of so much, then in that case, of course, I cannot use this is the formula you're expected to use. I can then say break-even points in Naira equal to fixed cost plus targeted profit after tax divided by 1 minus tax rates. All of this divided by CMR. So this is the formula for calculating the break-even point in Naira to earn a targeted profit. Okay, to earn a targeted profit after tax, if targeted profit after tax is given to you. So all these 6 formulas are what you are going to need to calculate your break-even points. Okay, all the 6 formulas are what you are going to need to calculate your break-even points. So that's that. All the relevant formula that you need in calculating break-even points, I've given it to you. And also, they are in this material, I think. Let me scroll down. Okay. Yes, they are also in the material. So the same thing, just go in there and pick them up. Pick them up. All right. So this is the last one. Okay. So just review them. Make sure you master them. Break-even analysis is very straightforward. Just take your time, understand the concept, and then once you know it, so you can't struggle with break-even analysis in an exam. All right. So that's that. What else? Now let's talk about margin of safety. Let's talk about margin of safety. So margin of safety simply represents the the degree or the extent at which the output can fall before a company begin to incur loss. Okay, I repeat, margin of safety is the extent to which output can fall before a company will begin or will start to incur loss. Now, the margin of safety is similar to sensitivity margin in under risk and uncertainty. So margin of safety is similar to sensitivity analysis. So a company may want to know what is the margin of safety? What is the extent to which our output can fall before we begin to incur loss? So, and then of course, margin of safety represents the difference between the budgeted sales value and the break-even point of sales, okay? The budgeted sales value and the break-even point of sales, all right? Of course, it can also be determined as the ratio of the difference between the budgeted sales, okay? The budgeted sales and break-even point on sales to budgeted sales. All of these are what margin of safety, and it's how to calculate the margin of safety. Now, like I said, if you want to calculate margin of safety, this budgeted sales will be given to you in the question, all right? If you have to determine margin of safety in Naira, you want to determine margin of safety in Naira, then the budgeted sales is the sales value that will be given to you in the question. Then you need to go ahead and calculate break-even point of sales. All right. You calculate break-even point of sales. So the difference between the two will then give you the margin of safety. If you want to calculate your margin of safety in percentage, okay, this one is in Naira. Okay, if you want to calculate your break-even point in percentage, then the budgeted sales minus break-even point of sales divided by the budgeted sales multiplied by 100% will give you the percentage at which the output can fall before a company will begin to incur losses. It is also possible the examiner may want you to determine margin of safety in units. Okay, so it will now be budgeted sales units minus break-even points in units. Okay, budgeted sales units minus break-even points in units. So that will give you the margin of safety in units. All right. So that is that. I think all the relevant formulas we have talked about them. So like I said, please go and form a note. Go and form a note in summary. Write it in your own class notes. The limitation of CBP, the factors, the uses of the assumptions of CVP, all these assumptions, all right? The uses of CVP and also the limitation. Please form a note on them so that you don't need to be reading from any textbook again going forward, since you have a summarized note. So it is that your notes you need to master going forward. Okay, that's that. There's one more areas we need to talk about under CVP. Let's talk about all what we have been discussing this, since some of them are majorly for single product organization. Therefore, how do you calculate break-even points for a multi-product organization? Let me see if I have it here. Okay. Yes, I also have it here. So how do you calculate break-even points for a multi-product organization? So the way the break-even point is calculated or is computed for a single product organization is different from the way it is computed for a multi-product organization. When you say a multi-product organization, so a multi-product organization is a company that produces more than one product. So when the company has product range and the company wants to break even, therefore, the way you are going to calculate the break-even point of that multi-product organization will be different from the way you do for a single product organization. Why is it so? Why is it different? Because for a multi-product organization, each product will have different selling price, different variable costs, and different profits to be achieved. Therefore, it is not appropriate for you to assume that each of the products will have the same selling price, the same variable cost, and all of that, because these things are different. The selling price are different from each product are different. The variable costs are also different. Therefore, it is important to follow the predetermined procedures for you to determine break-even points in Naira as well as in units for a multi-product organization. Now, when you want to determine the break-even points for a multi-product organization, there are 5 key procedures you are supposed to carry out. There are 5 key procedures you are supposed to carry out. The step one you should consider is to determine the overall contribution margin ratio. Okay, you need to determine overall contribution margin ratio. Now, this contribution margin ratio that you want to determine is not related to any of the products. So that's why I said overall contribution margin ratio. It's not related to any of, say, for example, you have product A, you also have product B and C. So you have sales value for A, sales value for B, sales value for C, then you have total. So by the time you add up all the sales value, it will give you this total. This is the sales. You also have variable costs for A, B, and C. By the time you less this, what you are going to have is the contribution. All right. Therefore, for you to get your contribution margin ratio, the overall contribution margin ratio, what I will do is to pick the contribution. I will pick the contribution, the overall contribution. I will divide it by the overall sales. That will give me the overall contribution margin ratio. That's what you should do. That's the first step. Step 2 is to calculate the break-even point in Naira for the entire organization. This break-even point in Naira also is not related to any of the products. It's for the entire organization. How do I do this? Simply divide the fixed cost, the company's fixed cost, you divide it by the contribution margin ratio you have computed in step 1. Okay, so that will give you the break-even points in Naira for the entire organization. Okay. Then step 3 is to calculate sales mix. You need to calculate sales mix, or what is called profit to sales ratio. How do you determine sales mix? Sales mix is the sales value of each product divided by the total sales value. For example, based on this hypothetical figures that I put on the screen, if I want to calculate sales mix for product A, for example, I will pick the sales value of product A, I will divide it by total sales value. So that will give me the sales mix of product A. I will do the same thing for B and C. All right. And that's what I'm saying here, that sales of each product divided by total sales of the company. Okay. So that's what you need to do in step 3. In step 4, you then calculate break-even points in Naira for each product. Okay. You calculate break-even points in Naira for each product. How do you do that? Simply multiply the sales mix that you have in step 3, you multiply with break-even point in Naira in step 2 for each product. Okay, so you are going to multiply. This is computed by multiply the break-even point in Naira for the company with the profit to sales ratio. That is, you multiply step 2 and step 3 for you to be able to get the break-even point in Naira. So once you have gotten the break-even point in Naira for each product, you can easily get the break-even points in units for each product. For you to do that, just divide the break-even point in Naira in step 4 with the selling price of each product. So that will give you the break-even points in units. That is, determine the break-even points in units for each product. This can be calculated by dividing the break-even point in Naira for each product with the selling price. That's it. That's it. So once you're able to follow, of course, all this is the way you're supposed to present your table for you to be able to get the break-even point in Naira as well as the break-even point in units in the same table. So step 4 and 5, you merge it together in the same table. All these figures are just hypothetical numbers. They are not real. I just put it there for you to be able to understand it, how to do it. So again, like I said, the CVP analysis is very straightforward. It's not something you should waste too much time on. All right, but just take your time, understand the concept, and begin to enjoy solving questions. Okay, so let me know if you have any question for me so that we can begin to solve now. If I'm able to solve 4 different illustrations, 2 under single product, 2 under multi-product, that will be fine for me. And I believe it will also be fine for you too. So give it to me. Let me know if you have any question for me before we begin to solve. Any questions so far? So if there's no question, let's move to solving illustrations. I'll stop sharing. Oh, okay. I forgot. We have not even read the question, sir. So let's solve. Let's go to illustration. Let me see the questions that we are going to solve. Let's start from illustration number 2. If time permits us, after illustration 2, we should also solve. Let me look for another scenario. We'll be able to solve this number 3. Those are under single products. Then under the multi-products, we can solve this. Illustration 5. Then under one more question okay, let's solve this one too. We also solve this one. All right. So I need somebody to read for us illustration number 2, Marina Industries. Somebody should read for us. Who will help us?
Marina Industries said sold 150,000 units of its products at 2 naira per unit. Variable costs are 15 naira per unit. Manufacturing costs of 12 naira and selling expenses of 3 naira. Fixed costs are incurred uniformly throughout the year and amount to 970,000 naira. That is manufacturing cost of 600,000 and selling of 372,000. We are required to calculate the break-even point in units and naira, the number of units that must be sold to earn an income of 75,000 naira before income tax, the number of units that must be sold to earn an after-tax profit of 100,000 naira if the income tax rate is 40%, the number of units required to break even if variable cost increase by 5% and fixed cost increase by 2.5%.
Thank you very much. Yes, that is the question. In the A requirements, so let me share my screen with you. I think I just lost the network. So let me know if you can see my screen, please. Can you
Yes,
see
sir.
my? Okay, thank you. So the name of this company is Marina Industry. Solution to illustration 2. Marina Industries Limited. Number A, in the A requirements, you have to determine break-even points in units and in naira. Therefore, I would then say A1, A Roman figure 1, calculating break-even points in units. Okay, calculating break-even points in units. Therefore, break-even points in units is calculated as fixed cost divided by contribution margin per unit. Please always write it out in full, or you define your variables. Don't just go and write FC. FC can mean football club, can mean football club. Only mute yourself. Therefore, I will go to the question, what is the fixed cost given to me? According to the question, fixed cost is 972,000 naira. Therefore, I would then say 972,000. Then I will divide with the contribution margin per unit. I will then go to the question, how am I going to calculate my contribution margin per unit? If in the question I'm given selling price and variable cost, then life has been made so easy for me. So in this question, I can see selling price to be 20 naira, variable cost to be 15 naira. So if that is the case, I would then say, I can come here to say selling price of 20 naira minus 15 naira variable cost. So this will give me 5 naira. Therefore, 972,000 divided by 5. equal 194,400 units. 194,400 units. So this is the number of units that must be produced for the company to be able to break even. The next one is A2. Calculating break-even points in Naira. Okay, therefore, break-even points in Naira equal to fixed cost divided by contribution margin ratio equal to 972,000 divided by contribution margin ratio. So for me to be able to get my contribution margin ratio, I need to divide the contribution margin per unit with the selling price. Selling price is 20 Naira. Contribution margin per unit is 5 Naira. Therefore, 5 divided by 20 will give me 0.2. It gave me 0.2. Therefore, I would then say 0.20. So what do you then get? Please, on the day of your exam, always go and do your work. You don't go and do it like this. Don't go and be saying 5 divided by 2, open a bracket, 5 over 20 equal to 0.2. That will make your work look so untidy. So it's better to go and do your work in somewhere. So go and calculate working for contribution margin ratio. Once you have your answer of 0.2, then you come and post. So don't go and do this under your main working. It will make your work look so terrible. This is 0.25. Sorry, not 0.2. 0.25. All right. Therefore, I would then say 972,000 divided by 0.25 equal 3,888,000 Naira. So if I don't want to do it this way, alternatively, I can say break-even points in Naira is equal to break-even points in units multiplied by selling price, which is equal to 194,400 units multiplied by 20 Naira. So I should have the same amount as 3,888,000. All right. So this is how to calculate break-even points in units as well as in Naira. In the B requirements, we have to determine the number of units that must be sold to earn an income of 75,000 Naira before tax. So you want to calculate, that's B. Requirement B, units required to earn a profit before tax of 75,000 Naira. Okay? Therefore, I would then say break-even points in Naira will then be equal to the fixed cost plus targeted profits before tax divided by contribution per unit. Okay? Which is equal to, the fixed cost is 972,000. The targeted profit is 75,000. Then contribution margin per unit is 5 Naira. Therefore, my break-even point in unit will then be equal to 972,000 plus 75,000. Sorry, 75,000 equal, then divide by 5 equal 209,400 units. 209,400 units is the units required to achieve a targeted profit before tax of 75,000 Naira. Okay. Then number C, you are to determine the number of units that must be sold to earn an after-tax profit of 100,000 naira if the income tax rate is 40%. So examiner has told us that after tax, you have been given profit after tax of 100,000 naira, and you have to determine the units required to break even. So in this case, number C, units required to achieve. Let me rewrite this. Units required to achieve a targeted profit after tax of 100,000 naira. So how do you do this? Very straightforward. I would then say break-even point in units will be equal to fixed cost plus the targeted profit after tax divided by 1 minus tax rates, all of that divided by contribution margin per unit. Therefore, my fixed cost is 972,000 plus targeted profit after tax of 100,000 naira. Tax rate is 40%. 1 minus 40% will give 0.60. Then divide by 5 naira. Final answer. I carry my calculator to say 100,000 naira divided by 0.6 equal plus 972,000 naira equal divided by 5 equal. That's 227,733. So 227,733 units. That's that. Okay. Next item. Requirement number D. The number of units I think the network is misbehaving here. I don't know. So let me share again. Sorry for the break in transmission. Please confirm you can see my screen.
Yes, sir.
Yes, sir.
Thank you. So the number D, you have to determine the number of units required to break even. If variable costs increase by 5% and fixed costs increase by 2.5%. So in this case, you need to first of all, since your variable costs will change, if variable costs change, then your contribution margin will also change because now, like I said, because our variable costs, we are told that it will increase. Variable costs will increase by 5%. So if variable costs increase by 5%, then our contribution margin per unit will reduce. All right. So we need to go and calculate that because the selling price remain constant. Since variable costs has increased, then the contribution margin will reduce. So let's first of all go and do our working for that. So let me just, without going too far, I will just come here and say number D, requirements. So we have to calculate units required. Units required to break even if variable costs increases by 5% and fixed costs increases by 2.5%. Therefore, I would then say break-even points in units equal to, of course, you know the formula, which is fixed cost. In this case, my fixed cost is going to be a revised fixed cost. So in that case, I would then come here, working number one. My variable cost has increased. So I need to calculate a revised variable cost. So the revised variable cost will then be equal to the original variable cost is 15 naira. We're now told that this variable cost will increase by 5%. Therefore, 15 naira multiplied by 1.05. What do you have? 1.05 multiplied by 15.
15.75.
That's 15 naira, 75 kobo. Somebody will ask me, how do I get 1.05? The 15 that you have here is 100%. Okay, that's the 100%. That's the one you are seeing here. 100% is 100 divided by 100. That will give you 1. The 5 that you are seeing here, this 0.5, sorry, this 0.05 is the increment of 5%. 5%, 100% plus 5%, that's equal to 105%. 105% is simply 105 divided by 100, which is equal to 1.05. So that's what we have done. So my revised variable cost is 15.75. If that is the case, I will also need to calculate, because my variable cost has increased to 15.75. So it means that my contribution margin will also change. Therefore, I can then say revised contribution margin per unit, which will be equal to my selling price is 20 naira minus the revised variable cost of 15.75. Therefore, my revised contribution margin will then be 4.25. Okay, will be equal to 4.25. So again, I revised cost. My current fixed cost is 972,000. We're now told that this fixed cost will increase by 2.5%. Therefore, 1.025. This will give me what? 972,000 multiplied by 1.025 equal to 996,300. Here is 996,300. That's the revised fixed cost. Okay, that's the revised fixed cost. So if that is the case, I can then go ahead and calculate my, again, somebody can ask me, how do you get 1.025? It's still the same thing. The 972 is 100%. The 972 is 100% plus 2.5% increase. That will give me 102.5%. That is 102.5%. Therefore, 102.5 divided by 100 will give me 1.025. So that's what we have done. It's not a magic. We have not done magic. Okay? So that's that. So let's go and calculate that. 996,300. Here is 996,300. Then divide by, remember we are using formula fixed cost divided by contribution per unit. Okay? So divide by the contribution, the revised contribution per unit is 4.25. 4.25. Therefore, what do I have there? Divide by 4.25 equal. That's
234,
234,
423.
424. Okay? 234, 424 units. That's it. That's the end of the question. So that's the end of, once you know the formula, every other thing will just fall into places for you. CVP is not difficult. All right. So let me know if you have any questions so that we can move to the next question. Remember, we have 4 illustrations. Okay. So in the absence of no question, I will stop sharing this and I will move to the working notes. Sorry, to the main notes. Okay, so let's solve the illustration number 3 with Jopagogo. Yes, somebody should read. Who will help us? Who will help us to read? Okay, I think I should be calling you guys now. So I don't want to volunteer again. Some of you have been quiet since day one. You don't talk in the class. It's like you just open your screen or your phone and put it in speaker without contributing anything. Therefore, going forward, I'll be asking you guys randomly to read for me. Yes.
The following
No, I
information.
don't want you to read. You have read it before. Thank you. Good. Adediwura, please read. Let me start from you. Adediwura, read. We want to hear your sweet voice.
Good evening, sir.
Good evening.
Sir.
Yes.
Okay, illustration 3. The following information is extracted by a financial analyst from the books of Jopagogo Industries Limited. So we have the scrolling
Start
down
from
to
A. Start from A.
You start from A. This you are
Yes.
required. Okay, you are required to calculate I, the profit volume ratio, and then high the break-even point. Do I go ahead?
Yes.
Okay, B high said a proposal has been made to increase fixed cost by 10,000. If says and variable costs remain unchanged, compute the new break-even point. Then the second B, the company is also considering another proposal for modernizing its existing plants. This will need additional fixed cost of 25,000 naira, with the expectation of saving the same amount in each of the direct materials and the direct labor costs. If this proposal is undertaken, compute the profit volume ratio, the break-even point, and the profit of the company. Then the last C, management accounting has an important role to play in decision-making. Discuss this statement, explaining the concepts which may be relevant and enumerate types of decisions to which they may be applied.
Thank you very much, Wura.
Yes, sir.
Yes, that is the question. That is the question. So in the A requirement, examiner wants you to calculate the profit volume ratio. So let me stop sharing this and move to the working notes. So we want to calculate profit volume ratio. So solution to illustration 3. Jopagogo Limited. So in the A parts, A Roman figure 1, you have to calculate profit volume ratio. When I was explaining the concept of contribution margin ratio, I mentioned to you that contribution margin ratio is the same thing as profit volume ratio. Therefore, I would then say calculating profit volume ratio. So PVR is calculated as contribution. I will go to the question. Depending on the information available, if I can get selling price, if I have selling price in the question, I also have variable cost per unit, then my PVR will be equal to contribution margin per unit divided by selling price. But if in the question I don't have selling price, but I can see sales value, total sales, then I can also see total contribution. Like in this case, in the question, examiner has given us sales value of 1 million naira. We're also given total variable cost to be 800. The difference between the 800 and 1 million naira is 200,000 naira. That 200,000 naira is the total contribution. So with this, I would then say total contribution divided by total sales. So this will give me the PVR, profit volume ratio. So which is equal to contribution is 200,000 naira. Okay. Divided by total sales of 1 million naira. So this will give me 0.20 or 20%. So this is how to calculate PVR or contribution margin ratio. Roman figure 2, A high. What are you asked to do? In the A high, you have to calculate the break-even point. You can see examiner is silent. You have to calculate break-even point. Which of the break-even points? Is it break-even point in naira or break-even point in units? If in this question I have selling price, okay, it will be easier for me to calculate contribution per unit, okay, because once I have selling price, I can also determine the I can easily determine the contribution per unit, because once I have selling price per unit, I will just divide it by the total contribution. I will divide it with the total sales. It will give me the number of units. Once I have the number of units, I will divide it with the total contribution, then I will have my contribution margin per unit. But in this question, there is no way you can calculate contribution margin per unit. Therefore, the break-even point you are going to calculate here will be break-even points in naira. So it will be break-even points in naira. Therefore, I would then say calculating break-even points in naira. Okay, so break-even points in naira will then be equal to the fixed cost divided by, in this case, examiner has asked us to use PVR. Don't say because CMR is the same thing as PVR. So whatever you are going to be doing, it has to be PVR. So I would then say divided by PVR. So you are not supposed to come and put CMR here, because examiner has asked you to use PVR, even though they are the same. Just be consistent, okay? So I will then go to the question, what's the fixed cost given to me? According to the question, the total fixed cost is 100,000 naira. So here is 100,000 naira divided by the PVR of 0.20. This will give me 500,000 naira. Okay, so that's that. The break-even point in naira, the number of the sales value the company must make for the company to be able to break even is 500,000. Okay, for the company to be able to break even, the company must make sure that they achieve a sales value of 500,000 naira. Let's go to B part. B, Roman figure 1. You are told that a proposal has been made to increase fixed cost by 10,000 naira. If sales and variable costs remain unchanged, compute the new break-even point. So in this case, number B1, we are told that fixed costs, I would then say break-even points in naira if fixed costs increases by 10,000 naira. So examiner has told you a proposal has been made to increase fixed costs by 10,000 naira. Therefore, of course, we are also told that sales and variable costs will remain unchanged. So if that is the case, then my break-even point in naira will then be equal to the revised fixed cost. The revised fixed cost will now be 100,000 naira plus the new 10,000 naira increase, then divide by the PVR of 0.20. So this should give me 550,000 naira. When you divide 110 by 0.2, you should have 550,000. Move to the next one. B2. The company is also considering another proposal for modernizing its existing plants. This will need additional fixed cost of 25,000 naira, with the expectation of saving the same amount in each of the direct materials and direct labor costs. If this proposal is undertaken, compute the profit volume ratio, the break-even point, and the profit of the company. So 3 things you are going to do here. But what the examiner is simply telling you here is that this new proposal will increase fixed cost by 25,000 naira. So if we are now told that if fixed cost increased by 25,000 naira, then of course the company is expected to save the same 25,000 naira from direct material and direct labor cost. So if that is the case, the first thing first you need to do is to determine a new or a revised, income statement. Okay, you need to determine a revised income statement. So if that is the case, this is B2. So the first thing you are going to do is to determine a revised income or budget statement. So the profit as given to you in the question, you need to do it again. Therefore, I will have sales value. Sales value remains as 1 million naira. Forgot to put naira sign. So sales value remain as 1 million naira. So I will then have variable costs. Under the variable cost from the question, from the table given to us, we have direct material of 300,000. Remember, we want to save 25,000 naira from direct material. Therefore, I would then say direct material. Let me write that. Direct material. Original direct material is 300,000 minus 25,000 that you want to save. So we have a balance. Let me just remove this. You have a balance of 375,000. Sorry, 275,000. 275. The less. You also have direct labor of 300,000. Direct labor 300,000. You also save 25,000 naira from there. So that will reduce it to 275,000. Next item, you also have variable factory overhead. Factory overhead is the same, it's not changing, which is 80,000 naira. The less. After that, we also have variable marketing expenses, 70,000. Variable marketing expenses, 70,000 naira. Then we have variable admin expenses, 50,000. Admin expenses, 50,000. So find the difference. 275 multiplied by 2, that's 550. 550 plus 200, that's 750. 750 minus 1 million, that will give me 250,000. So this 250,000 is the total contribution. That's total contribution margin. Then after that, I need to less fixed cost. I will then say fixed cost. Under the fixed cost, we have fixed factory overhead of 50,000. So fixed factory overhead of 50,000 naira, the less. You also have fixed marketing expenses of 30,000. Marketing expenses of 30,000. Okay. Then we have fixed admin expenses of 20,000 naira. Then examiner has already told you that there's an additional fixed cost of 25,000 naira to be incurred. So I would then say additional fixed cost, 25,000. So this will give me, by the time you add up all of this, that's 125,000. 125,000 minus 250, that will give us profit of 125,000. So that's a revised profits. Okay, so that's what examiner wants you to do. That's not all, because examiner asks you to determine, you have to determine you have to compute the profit volume ratio, break-even point, and the profits. So there is no how you can determine the PVR or the break-even point without first of all determining the profits. That's why we went ahead and do this. So after this now, I need to determine my contribution margin. I will then say calculating profit volume ratio. So the revised PVR will then be equal to the new total contribution of 250,000. Okay, 250,000 divided by sales of 1 million naira. Okay, divided by sales of 1 million naira. Okay. So what do you have there? 250,000 divided by 1 million naira.
It's
Now
0.25.
0.25. Here is 0.25 or 25%. So that's that. Finally, I need to calculating break-even points in naira. Therefore, break-even points in naira will then be equal to the new fixed cost is 125,000 naira, which is 125,000 divided by the new PVR. The new PVR is 0.25. Okay, so what do you have there? 125,000 divided by 0.25 equal to 500,000 naira. So that's what the examiner wants you to do. All right. So whenever you're asked to make an adjustment, you should know what to do at the right time. This is one of the scenario now.
I'm here with you 100%.
Maybe that's why the network is frustrating my presentation tonight. The
Who
thing is
am
just
I?
breaking, off and on and all of that, disrupting the class. Please talk to the network to stable. All right?
Oh, okay, sir. I'll do that right now.
Okay then. It's all right. So let me share my screen again. Now, in the C part of the requirements, examiner is asking you, okay? You are asked in the C part of the question that management accounting has an important role to play in decision making. Discuss these statements, explaining the concepts which may be relevant and enumerate types of decision to which they may be applied. What the examiner is simply asking you here is to talk about marginal costing technique and relevant costing in relation to decision making. That's all. Just explain the concept of marginal costing technique, relevant costing, and you are good to go. That's that. When you look at the to the ebook, the PDF material, which you see there, all my explanation are all there. So let's move to multi-product break-even. Let's move to multi-product break-even. So I'll be very happy if I can complete this tonight, the remaining two illustrations. All right. So, yes. Yes, let me call one of you to read again. Yes, Ajay, please read. Ajay, are you there? Amarachi, please read.
Okay, so which one am I reading? Hello.
It's coming, it's offline now. You come up again.
Okay.
I don't know what's wrong with this network tonight. Please, you have to bear with me. I don't know. Just going off and on. Yes, Amarachi, I called your name to read. Go ahead.
Okay, so which one am I reading?
Yes, illustration number 5, Ogadinma.
Okay. Ogadima Limited retails two products, common and executive traveling bags. The budgeted income statement for year 2015 is as follows. All figures stand to be correct. Required. A. Calculate the break-even units, assuming that the planned revenue mix is maintained. B. Determine the break-even point in units if only common bags are sold and if only the executive bags are sold. C. Calculate the budgeted operating profit and break-even point if 200,000 units are sold, but only 20,000 are executive bags.
Thank you very much, Amara. So that is the question. In the A requirements, you have to calculate break-even points in units, assuming that the planned revenue mix is maintained. When you look at this company, Ogadima, you will notice that Ogadima produces two products, common bag and executive bag. So in that case, this is a multi-product organization. Therefore, the way you calculate break-even points for a single product organization is different from the way you do for a multi-product organization. Now, in the requirements, examiner is asking you to calculate the break-even points in units, okay? Calculate the break-even points in units, assuming the plan revenue mix is maintained. What are you supposed to do here? For you to be able to answer the A correctly, just follow the normal procedure, the 5 procedures I gave to you earlier in computing break-even points in units for the organization, for an organization. Therefore, let me stop sharing this and move to the working note so that we can quickly solve the question. So, solution to illustration number 5. Ogadinma. Is it Ogadinma Limited? Yes. Ogadinma Limited. Number A requirements. Examiner wants us to determine break-even points in units. Okay? For each product. So I would then say calculating break-even points in units. That's what the examiner wants us to do. Now, there is no way you can calculate, there is no formula that you can use directly to get the break-even points in units for each product without following the normal procedures. You can't jump it, all right? Therefore, the first step, whenever you want to calculate break-even points in units for a multi-product organization, the first step you are going to do is to calculate the overall contribution margin ratio. So you need to calculate overall contribution margin ratio, which is equal to, I will then go to the question, how am I going to calculate the overall contribution margin ratio? It will be total contribution for the organization divided by the total sales. So that will give me the overall contribution margin. So when you go to the question, you will notice that for common bag, the sales revenue for common bag is 60 million naira. Executive is 30 million naira. We are less concerned for each product. Move to the entire, for the total. Total is 90 million for the entire organization. Then the total contribution for the entire organization is 30 million. Therefore, 30 million divided by 90 million, that will give me the contribution margin ratio. Here is 30 million divided by 90 million naira, which is equal to 1/3. 1/3 or 0.123456789. You have to write out everything in full. You don't restrict it, you don't round your number. Once you round your number, you can't get the full number. You only make rounding until you get to the final numbers. When you want to write out the final number, you can round it. But at this point, you cannot round, because once you round before the final number, you are not get to, you may be close to the right number, but it should not be appropriate. Therefore, always write it out in full, like I've done now. Okay? So that's step 1. Step 2 says you should calculate break-even point in naira for the entire organization. So step 2, break-even point in naira for the entire organization, which is equal to fixed cost divided by contribution margin ratio. Okay, so I will then go to the question, how much is the fixed cost? We are told that fixed cost of 12 million naira. So here it will be 12 million naira divided by 0.333, or you can say 12 million naira multiplied by 3, because 12 million divided by 1/3. So mathematically, so the 3 that is denominator will become numerator. So 12 million multiplied by 3, or simply say 0.33345678 So of course, your answer should be 36 million naira. Here is 36 million naira. So that represents the break-even point in naira. Step 3 says you should calculate sales mix. Okay, step 3 says you should calculate sales mix for each product. Therefore, how do you determine sales mix? We have common. We also have executive buy. Therefore, to get the sales mix simply means profit to sales ratio. What is the sales value of each product divided by the total sales value? The sales value of common is 60 million. Okay, 60 million naira divided by total sales value of 90 million. So this will give me 6/9. Okay, 6/9 will give me 0.6664567, then 7. All right. Then also for executive is 30 million naira. The sales value for executive is 30 million naira. Therefore, 30 million divided by 90 million. This will give me 1/3. This will give me 1 over, that's 1/3. What am I saying? Sorry, Gary. Yes, 6 over 9, 3 over 9. That's 1/3. It's the same thing as 1/3. This one also is 2/3. But again, you don't just waste your time. You can just say 3 over 9. Just say 3 over 9. So if it's 3 over 9, this will give me 0.1, 2, 3, 4, 5, 6, 7, 8, 9. So by the time you add the two together, it will be equal to 1. Okay? So that's that. This is the sales mix. This is the sales mix or profit to sales ratio. Yes, step 4 says you should calculate break-even points in naira. Then step 5 says calculate break-even points in units for each product. So I will merge step 4 and 5 together in a table, which is calculating break-even points in naira and break-even points in units, in naira and in units. Okay, so let's use a table to achieve this. So we are going to create a column for products, which is common. Then we have executive. Then we have sales mix. Under the sales mix for common is 0.6, 6, 6, 3, 4, 5, 6, 7, 8, then 9, 0.3, 2, 3, 4, 5, 6, 7, 8, 9. So by the time you add it together, it should give us 1. Here is 1, which is 100%. Okay. Then we are going to have break-even points in naira. Let me write that. Break-even points in naira. Then we have selling price per unit. Then finally, we are going to have break-even points in units. Okay, so that's that. Okay, let me complete my table. All right then. So the break-even point, first thing first, you have to start from the break-even point in naira for each product. For you to get the break-even point in naira for each product, you are going to multiply the sales mix with the total break-even point in naira for the entire organization of 36 million naira. So you want to distribute 36 million naira between common and executive. Therefore, 0.66667 multiplied by 36 million. All right, I will say 36 million.
24 million.
24 million, thank you. So here is 24 million. Then here will be 12 million then. So by the time you add it up, that's 36 million. Selling price of common is 200. Selling price of executive is 300. Here is 200. Here is 300. Therefore, 24 million divided by 200. What do you get? That should be 120,000, I'm correct. Then this should be 40,000. That's all. 3 marks. You shouldn't waste too much time on this. 3 marks. You pocket it out of 15. Move to the next one. The next requirement, which is B, you have to determine the break-even point in units if only common bags are sold and if only the executive bags are sold. That is, you should assume that only common bag is produced by the company and then only executive bags is produced by the company. Is the only product that the company has. That's the interpretation. So number B requirements. Number B, break-even points in units. Is it in units? Yes, break-even points in units. That's it. This will be B1. Break-even points in units if only common bags are sold. So we are assuming that only common bag is the product that the company has. If that is the case, then the break-even point in units will be equal to the fixed cost divided by contribution per unit. Okay, contribution per unit of common. So the fixed cost of the organization is 12 million naira. So what's the contribution per unit of common? So for common, the selling price of common is 200 naira. Variable cost of common is 140 naira. Therefore, 200 naira minus 140, that will be 60 naira. Contribution per unit of common is 60 naira. Therefore, what do you have there? Let me put it there.
2,000.
Pardon?
2,000.
2,000 or 200,000?
12 minutes.
200,000. 12 million divided by 60 naira. That's
Okay,
200,000
200,000.
units. Okay. Then B2. B2. Break-even points in units. If only executive bags are sold. In that case, break-even points in units would then be equal to fixed cost of 12 million naira divided by contribution per unit of executive. The selling price of executive is 300 naira. Variable cost per unit of executive is 180 naira. Therefore, 300 minus 180. This will give us 120 naira. So 12 million divided by 120 naira will give us 100,000 units. So that's that. 6 marks. This is too small. I mean, this is too much. The question is too much. How can I be, the first one supposed to even be more than 3 marks? Okay, this one is very more straightforward. Then the last part of the question, number C. Okay, I think this question was tested, was it 2015 or 2016? I can't remember clearly. Yes, the C part, you have to calculate the budgeted operating profits and break even points if 200,000 units are sold, but only 20,000 are executive bags. Okay, 6 marks, 6 bonus marks. In this particular requirement, there are 3 things you are going to do. First thing first, you must determine the revised profits. Once you determine the revised profits, then of course, you now calculate the revised contribution margin ratio, then you now determine the break-even points in units. So to do this, number C, okay, let me say C, Roman figure 1. C, Roman figure 1, I need to calculate the revised income statements or budgeted statements. Okay, so the statement the examiner has given to us, we have to redo it. Examiner has told you in the question that only 20,000 naira is executive bags. That means 180,000, sorry, 180, only 20,000 units is for executive. It means that the balance of the 200,000 of 180,000 units represent for, I mean, it's meant for common. So here I will say common bags, executive bags, then total for the organization. So you have been told that 20,000 units out of the 200, 20,000 units out of these 200,000 units, 20,000 units is for executive. It means that the balance of 180,000 units is for common. So if that is the case, we need to re-prepare our income statements. So with this, I would then say sales. Examiner has used revenue. No worries. Selling price is 200 for common, then 300 for executive. Therefore, I would then say 200,000, 200 Naira multiplied by 180,000 equal 36 million. Okay. Then 300 Naira multiplied by 20,000 equal 6 million. When you add the two, that's 42 million Naira. Next, based on the format as given in the question, the next item is variable cost. So variable cost. Variable cost per unit for common, 140, executive, 180, 140 versus 180. Therefore, 180,000 multiplied by 140 equal 25,200. 25,200,000. Okay. Minus 36. That's 10,800,000. This represents the contribution. Okay. Then the next one, variable cost for executive. 180 Naira multiplied by 20,000 equal 3.6. 3,600,000. When you less it, we have 2.4 million. Then, of course, that will be 28,800,000. When you less from that, that will give us 13,200,000. So I will close this. I will now less fixed cost. The total fixed cost is 12 million Naira. So this will give us revised profit of 1.2 million. Okay, so that's that. Out of the three, the examiner wants you to do for operating profit is now 1.2 million based on this new change. So as a result, so we have two more left in that particular requirement. The next thing we want to do now is to determine break-even points. Okay, to determine break-even points in units for both executive as well as common badge. So before you can determine the break-even points in units, you need to first of all determine calculation. You need to calculate contribution margin ratio. Just follow the procedures. So in this case now, for me to determine, I would then say C high, calculating break-even points in units for both common and executive. I cannot achieve this. I need to start all over again, the 5 procedures. I would then say overall contribution margin ratio. My overall contribution margin ratio would then be the total contribution of 13,200,000 Naira divided by the total sales of 42 million Naira. Okay, So this will give me what? 13,200 divided by 42 million equal. Again, don't forget what I told you. Don't round your number. You have to write everything out in full. This is 0.31. Okay, 0.3142. All right, 3142. What again? 8571. 8571. How many are those? That's 8. Let me add one more. 81. 3142. 857143. Okay. 7143. 43. So let's stop it there. 1, 2, 3, 4. You can even stop at any case. That's it. Then, of course, that's step 1. Step 2 says you should calculate the overall break-even points in Naira. So I would then say break-even points in Naira equal to the fixed cost divided by the overall contribution margin ratio. Fixed cost is 12 million Naira divided by 0.3142857143. So from my calculation, I would then say 12 million divided by 0.3142857143 equal, that's 38,181,818 Naira, 818. So this represents the overall break-even point in Naira. That's overall break-even point in Naira. The third step is to calculate the sales mix. Okay. Sales mix. Okay. For common. Then for executive. Okay. So for common, the sales value of common based on our revised income statement, the revenue for common is 36 million. Revenue for executive is 6 million. Total is 42. Therefore, I will say 36 million divided by 42 million Naira. So, what do you have? 36 divided by
0.8571.
Okay. 0.8571.
428.
42857. Okay.
1.
42857. Okay. 8571. 42857. Let me confirm. 42857. Yes. 71. Let's stop it there. Again, for executive is 6 million Naira divided by 42 million Naira. So 6 divided by 42 equal to 0.14. Okay. 14285. 71429. 71429. How many are these? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So that by the time you add the two together, it must be equal to 100%. That is equal to 1. So that's the 6 means. The final thing we are going to do now is to determine the break-even point in units, break-even points in naira, and also in units. Let me move to the next line. Or can I manage this space? Okay, let's just move to the next one. I need 2, 3. Okay, this should be sufficient. So I will manage, I will say break-even points in naira and units. This will not be sufficient. This space will not be sufficient for me. So I have the products, the sales mix, then I have break-even points in naira, selling price, then break-even points in units. Okay. Products common, then executive. Let's manage this space. Okay. All right then. So the selling price of common is 200 naira, 300 naira. So here is 0.85 7142 8571. Here is 0.14 142 8571 429. When you add it together, it should give you 1. So the break-even points in naira that we want to share is 38,181,818 naira. That's the total break-even points in naira that we want to share. Therefore, I would then say 0.85 714 285 71 multiplied by 38 181,818 equal 32 727 273. 32 727 273. Okay, then the other side, which is 38 181,818 multiplied by 0.14 285 714 29 equal 5454 547. Okay, here is 5454 5454 547 547. So let's confirm if it is equal to the total. Otherwise, 32. Are you guys still there? 727
Yes, sir.
273
Yes, sir.
plus 5454 547. So it's not balanced. That means the percentage in our sales mix is different. It's not equal to 1. That's why it's not balanced. Okay, it's not. This is, I have 38 181 820. So it's over by 2. So let's redo it. Let me confirm this one first. 0.85 714 28571 plus 0.1428571 equal. This is 1. It's correct now. So maybe I made a mistake when I was multiplying. So let me redo it.
The first one for common is 32,727 272.57.
272.57. When you round it, it will give you 273.
I feel maybe because we are rounding it up, that's why it's not giving us the
Okay. Well, in any case, but you guys understand the concepts. So that's what we have done. Then so the next thing you need to do now is to get the break-even point in units. For you to get that, just divide the break-even point in naira. You divide it by the selling price, which is 32. Let me redo that one for the last time. 0.857142 8571. Okay. 8571. They multiply by 38. 181818. Oh, sorry. 38. 181818 equal to 32,727,272. 272. Then the last number I have to round. That's why I rounded it to that. But in any case, divide by 200.
Sir,
Yep.
sir, the second one is 5454545, not 547.
545. Oh, okay.
Yes,
So
sir.
here is 163. Here is 163. 636. 636. Let me confirm the second one again. 0.1428 571 429 multiplied by 38,181,818 equal 5454. Oh, 545. Right, it's true. So thank you. So that's that. Then divide by 300 naira equal 18,181, 189, 182 rather. So here is 18,182. That's it. That's end of the question. Just 15 marks. Just 15 marks. All this stress since 15 marks. So you pocket it. So let me know if you have any question. If not, just let's solve the one more illustrations and that will be all. All right.
Yes, sir. Please,
Okay.
I'm
Yes, talk to me.
lost.
You are lost where? Let me find you.
Yeah, that's the variable cost. When we are calculating C1, the reverse income statement. How do we get the revenue and the variable cost?
Hold on. Are you talking about this new table, this table here?
Yes, sir. The reverse income statement.
How do we get it?
Yes, sir. The 30.
So examiner has told you now, you are told in the question that in number C requirements, you have to calculate the budgeted operating profits and break-even points if 200,000 units are sold, but only 20,000 are executive bags. Therefore, out of the 200,000 units that will be sold, 20,000 is for executive. So if 20,000 is for executive, it means that 180,000 is for common. Therefore, all you need to do is to just multiply the selling price per unit of common, which is 200 naira multiplied by 180. That will give you 36 million. For executive, 300 naira, 300 naira multiplied by 20,000 units. That will give you 6 million. Again, variable cost of 140 naira per unit of common multiplied by 180,000 units. That will give you 25,200,000 naira. Then for executive, 180 naira multiplied by 20,000, that will give you 3.6 million. That's what we did. Is it clear now?
Yes, sir. Very clear. Thank you.
You're welcome. So let's have one more illustration on this, and that will be all for CVP. Let's have one more. The last illustration. Move to your material. Let's have the last illustration. So who will read for us? If not, because you asked question now, Tom Grace. I've not heard your voice today. So you read for us, Tom Grace. Tom Grace, read.
All right, sir. Illustration 6. Abayomi PLC produces and sells two major products, A and B. The budgeted income statement for the year to December 31st, 2022 is given below. Products, then the budgeted selling price of the products are A, 120, B, 180 required. A, determine the break-even sales in unit for each of the products using the budgeted data. Now, assume that the following changes are made in the budget. I, unit selling price of product B is reduced to 160 naira. II, direct material cost is expected to drop by 10% for product A and 20% for product B. Direct labor cost for each product will increase by 10%. Additional 456,000 will be spent on advertising. Then last one, 80% of total revenue will be derived from product B. Then B, calculate how much sales revenue must be made to earn an after-tax rate of returns of 12% of the revenue, assume tax rate of 40%. Assuming all the facts in B, that's I to V, above, but with the original budgeted revenue of 36,600,000, compute the reverse break-even sales in unit for each of the products.
Thank you very much, Tom Grace. That is the question. This is the last one we are going to solve under this topic. So examiner is asking you in A part to determine the break-even points, the break-even sales in units for each of the products using the budgeted data. So you can see that this company is a multi-product organization. Abayomi PLC is a multi-product organization because the company produces both products A and B. So I will stop sharing this because of time. Let's move to the working notes. Okay. So solution to illustration number 6. Yes. Solution to illustration number 6. Abayomi PLC. So number A, requirement of the question. You are to determine the break-even sales in unit for each of the products. So just follow the 5 procedures. So number A, calculating break-even points in units for each product. So let's follow the 5 procedures. Step 1 says you should calculate overall contribution margin ratio. Therefore, for me to get the contribution margin ratio, I will go to the question. I need to get the total sales, total contribution. Total contribution, then divide by total sales. Is it in the question, are we given sales or revenue? Whatever. So sales, you are given sales. So now, let's go back to the question. We want to determine contribution is not given in the question. Therefore, we need to go and work it out. So let's go and work out our contribution. This page, the second page, let's say the third page will be for our workings. So let's start our working from here. Working about, let's say working. Working number 1, we want to determine calculating contribution. We want to determine contribution margin. Product A, product B, then total for the organization. So I don't need to waste time on this. I will just go straight to the question directly. How am I going to get my contribution? I'm given sales value. I also have direct material cost. I have direct labor cost. There are 2 direct labor costs in the question. The second direct labor cost is not direct labor. It is direct expenses. It's a typo error. It should have been direct expenses. Okay? Therefore, I also have, yes, those are the 3 variable costs we have in the table. Therefore, what I need to do is to add the 3 of them together, then I will less from the sales for each product. So that will give me the contribution for each product and then the total contribution. Or I can say gross profit of 3,360 plus fixed cost of 560. That will give me 3,920 for product A, then 12,880 plus 1680. So that will give me 14,560 or thereabout. Okay, so that will be for that. Then I will get the total contribution as well. For me to get the total contribution, I can also say 16,240 plus 2,240. That will give me 18,480. In any case, so you can follow that anyhow you want to do it, you are good to go. Okay, anyhow you want to do it, you are good to go. If I don't want to do it, okay, because of time, let me just follow one route and so I can say sales equal to sales for A. Please be calling the number for me so that we can finish on time. Be calling the number for me.
8,400.
8,400. Figures are in thousands. 8,400. And next one.
25,200.
25,200. Then the total
33,600.
is 33,600. Then I will now less variable cost. Under the variable cost, I have direct material. How much is direct material for A? 2240. 2240. Then for B,
5,040
5,040. When you add it up, that will give us
7,280.
7,280. Then we also have direct labor. Direct labor of A is what?
1,120.
1,120. Direct labor of B?
3,360.
3,360. When you add it up, what do you get? That's 4,480. Then we also have direct expenses. Like I said, the second direct labor is not direct labor, it's direct expenses. It's a typo. So here is 1,120. For B. B is what? 2,240.
Yes, sir.
2,240. When you add the 2 together, that will give you 3,360. Here is 3,360. So let's find the difference. The difference is the contribution that we are looking for.
For A, 3,920.
Yes, I'm even looking for total contribution. So this will give me 3,360 plus 4,480 plus 7,280 equal, then minus 3,600 equal 18,480. So 18,480 is the total contribution that we are looking for. I don't need contribution for each product. So once I have the overall contribution, then I will now divide it by the overall sales.
Yes.
Okay, so let's go up there. My total contribution is 18,480 equal to 18,480 divided by 3,360. This is equal to divided by
55%.
336. That's 55%, 0.55 or 55%. Okay. Step 2 says you should calculate the overall break-even point in Naira. So break-even points in Naira for the entire organization would then be equal to fixed cost divided by overall contribution margin ratio. So the fixed cost for the organization, what is the fixed cost? We have two different fixed costs here. So let's go and do working for that. So working number 2 now. Working number 2, fixed cost. Okay. We have fixed overhead. Fixed overhead. The total fixed overhead is equal to, according to the question, total fixed overhead is 2240.
Yes, sir.
2240. So here is 2240. We also have fixed selling and admin expenses. So fixed,
8320.
yes, selling and admin, which is what? 8 what?
8320.
8230. Add it up. That's 10,560.
560.
Yeah. So the total fixed cost is 10,560. So that's that. I will then go up there. 10,560 divided by 0.55. This will give us
19,200.
19,200. That is 19,200,000. Remember, our figures are in thousands. Okay. Then step 3 says you should calculate 6 mix. Calculate 6 mix. So how do we get the 6 mix? There are 2 products, product A, then we also have product B. So for product A, I will divide the sales value of product A. And the sales value of product A is 84. 84 divided by 33,600. Then the sales value of product B is 25,200 divided by 33,600. Therefore, what do you get?
0.25, 0.75.
0.25, 0.75. That's 100%. Then the last step, step 4 and 5, we merge it together. So we want to determine break-even points in Naira. We start from the break-even point in Naira and break-even point in units. Okay? So we use one table to kill it. Products. Product A, product B, then sales mix. You can see it's not difficult. Just understand the procedure. It's the same thing. No matter how big is the question, it's the same. Then selling price, break-even points in units. Okay? Here is 0.25, 0.75, 1.0, okay? What's wrong with you? So we want to share. Now, when you get to this point, when you want to share the break-even point in Naira, you have to write it out in full. Remember, our figures are in thousands. So the 19,200,000 is what you want to share. Don't restrict it to thousands. Therefore, what is 0.25? 0.25 multiplied by 19 million, 19,200,000 equal 4.8. 4.8 divided by selling price. What's the selling price of A? According to the question, we are told that selling price is 120 for A, 120, then 180 for B. Therefore, 4.8 divided by 120 equal 40,000 units. Okay, that's that. Then 0.75 multiplied by
14,400,000.
14,400,000. So divide by 180 naira. What do we get? Divide by 180.
80,000.
80,000 units. So that's that. We are done with the first requirement, which is just 6 marks out of 15 marks. Okay, that's something. Then let's move to B. In the B part, you have to calculate how much sales revenue must be made to earn an after-tax rate of return of 12% of the revenue, assume tax rate of 10%. So examiner has given you a revised figures. You have been given an additional information. You are told in additional information 1 that unit selling price of product B is reduced to 160. So original sales price or selling price of product B is 180. You are now told that it has reduced to 160. Direct material is also expected to drop by 10%. So without wasting time, so let's make adjustments for all those numbers, because once your variable cost changes, then your contribution margin will also change. So let's make adjustment for all of that. Let's go and do workings. Working number 3 now. Working number 3, what do we want to do? We are told that direct material cost will drop by 10% for product A, then 20% for B. So let's make adjustments. I will say direct material equal to direct material for A, for product A, then for product B. So direct material of product A is how much? Direct material for A is 2240. So
Yes,
here
sir.
is 2240. We're now told that it will drop by 10%. It will fall by 10%. So if direct material fall by 10%, that means we are supposed to account for only the 90%. So I would then say multiply by 90%. Give it to me.
2016.
2016. Then the other side, the B for B, 5040. 5040. We're not told it will fall by 20%. That means we are supposed to account for 80%. So 2016. So what do you get?
4032.
4032. Okay. 4032. That's that. If you like, we can add it together or just leave it first. Let's leave it. Then working number 4 now. We are now told again in the same, we are told that direct labor cost for each product will increase by 10%. Direct labor cost. Direct labor for A and B. So how much is direct labor cost? Total direct labor cost for A is 1120. So 1120, we are told that we increase by 20%. Is it increase of 4?
Increase by 10%.
So we increase by 10%. So if it will increase by 10%, that will be 1.1. Okay?
Yes.
So what do you get?
1232.
1232. Then what's the total direct labor cost for B? That's 3360. 3360 multiplied by 1.10. What do you get?
3696.
3696. Okay. Let me write that. Okay. Now, again, you are told that, of course, additional 456,000 will be spent on advertising, which means our fixed cost will also increase. So let's calculate revised fixed cost. Working number 5, fixed cost. Okay. The original fixed cost is equal to 10,560,000. I think we did that in working number 2. Yes, this is it. 10,560,000. We are now told that additional fixed costs will be incurred of 456,000. So this will give us 11,000. Is it 016? Please confirm. It should be, yeah. That's 11,016. Kunle, are you still there?
11 million and 16,000.
Okay, then, so that's that. Any other adjustment? I think that's all. So at this point, the only thing we need to do now is to calculate the revised contribution margin ratio. Okay? Remember, all these adjustments, of course, if your variable cost change, since selling price remains the same or total sales remains the same, but variable cost is changing, again, it will affect the contribution margin. So in this case, we need to go and calculate a revised contribution margin. So working number 6, contribution margin. Okay. For product A, product B, then total for the organization. So the sales value of product A is not changing, which is 8,400. But the examiner has told us that the selling price of product B is reduced to 160 naira. So if selling price of product B has reduced to 160 naira, then that means the total sales of product B will also will reduce. So if that is the case, let us go and calculate the revised sales of product B. That would be working number 7. Let me push it to this place. I don't know the extent. Let me see. Let me push it to this point. Number 7. So revise sales. Revise sales of product B. Okay. So revise sales of product B. Revise sales value of product B. So for us, examiner has told us that the sales of product B, the selling price of product B has reduced to 160 from 180. Therefore, what we need to do is to multiply the 160 naira by the sales, by the units sold for product B. But we don't know the units sold for product B. So what that means is that we need to first of all determine the units sold for product B. How do you determine the units sold for product B? So the original sales of product B, first thing first, I will say units. We need to determine the number of units sold for product B originally. To do this, the total sales of product B, I think, is 25,200. Yes, 25,200. 25,200. 25,200,000 divided by the original selling price of product B, which is 180 naira. Divided by 180 naira. So this will give us what? Kunle, are you still there?
140,000.
140,000 units. This is 140,000 units. So the units sold for product B is 140,000 units. Therefore, for me to now get the revised sales value, therefore, I would then say sales, let me call it revised. Revised sales of product B would then be the original unit of 140,000 multiplied by the new selling price of 160 naira. So which is equal to what?
22,400,000.
22 million what?
22,400,000.
400. Please, you have to be very careful. Remember, our figures are in thousands. Okay? Our
It's
figures are in
22, sir.
thousands. 22.
I
Oh,
said 20. Yes, sir.
error of mind. 22,400. So that's that. Figures are in thousands. Figures are in thousands. So if that is the case, let's go and post 22,400. Add it up to 8,400. What do you get? That's
3,800.
3,800. Then we don't have the revised variable cost. Under the variable cost, our direct material has changed. Okay, I would then say direct material. For A is 2016.
Yes, sir.
For B is 4032. 4032. When you add it up,
60,48.
60,48. Then direct labor for A is 1232. 1232. Then for B is 3696. When you add it up, that will be
4928.
4928. Then we also have direct expenses, which is originally is 1120. No change in that one. Then 3 words.
2240.
Direct 2240. Yes, 2240. When you add it up, that will give us
3360.
360. Okay. So let's find the difference. Find the difference. So I will say 2240. Let me do for B.
4032 for A.
4032. Okay, this is contribution. Then for B, what do you have for B? Others are not in the class
12,
again.
12432.
12432. So let's forget about the total. I don't need the total for anything for now. What do we want to even calculate, Seth? Let me go back there. What do we want to calculate? Okay. Oh, okay. Is number B requirements. So we are doing for number B requirements. Examiner has told us in the B requirement, examiner has told us that we should calculate how much sales revenue must be made to earn an after-tax rate of return of 12%. So this is just like the sales value required to achieve a targeted profit after tax. So instead of the examiner to give us targeted profits in Naira, we are given the targeted profit in percentage. Therefore, I would then say sales revenue require, let me write this. Sales revenue required to earn after tax rate of return of 12%. So in this case, it's still the same formula that you are going to use. Therefore, I would then say, instead of me to say break-even points in Naira, I would just say sales revenue. Sales revenue equal to, is the same formula that you are going to use. Fixed cost plus targeted profit after tax divided by 1 minus tax rates, then divided by contribution margin ratio. Now, when you look at this question, examiner was specific by telling you in the additional information number 5 that 80% of total revenue will be derived from the product B. So whenever you are given a proportion, you are given the proportion of the products under break-even. Once you are given the proportion of the products and you want to calculate contribution margin ratio, it has to be composite contribution margin ratio or weighted average contribution margin ratio. So because the examiner has told us that 80% of the total revenue will be derived from product B, in that case, we need to calculate composite or weighted average contribution margin ratio. So it is not going to be normal contribution margin ratio. So first thing first, how do you calculate your composite contribution margin ratio? You need to calculate first contribution margin ratio of each product. Then you now multiply the weight of each product with the contribution margin ratio that you have determined. So that's what we are going to do here. Therefore, I would then say, of course, this one should be composite contribution margin ratio. Therefore, my sales value, I don't know the sales value because examiner has told me that 12% to earn after tax rate of return of 20% on revenue. Okay, let me go back to that requirement of the revenue. Okay, on revenue. I don't know the revenue. This revenue, the examiner has told me that they're going to earn 12%. I don't know it. That revenue is unknown. Therefore, you need to work it out. So the sales revenue now, let's say, you then say, let's sales revenue equal to X because I don't know it. My fixed cost, my revised fixed cost, I know it. I've done the calculation. My revised fixed cost is now, I think that's working number 5, 11,016. That's my revised fixed cost, 11,016. Okay, here is 11,016. Then targeted profit after tax. Targeted profit after tax, examiner has told us that it's 12% on revenue. Therefore, I would then say 12% of X. I don't know the X. 12% of X will be equal to 0.12 of X. I'll keep it on one side. My tax rate, T is equal to, according to the question, we are given a tax rate of 40%. So here is 40%. Let me say 1 minus tax. 1 minus tax equal to 1 minus, let me rewrite this. 1 minus tax is 100% minus 40%, which is equal to 1 minus 0.40 equal to 0.60. Then my contribution margin, my composite contribution margin ratio, I don't know it. I need to go and work it out. Before I can get my composite contribution margin ratio, I must first of all determine contribution margin ratio for each product. Therefore, let's continue our workings. So I would then say, since I've calculated contribution margin for each product, then my contribution margin ratio, let's say this is A, this is B. So my contribution margin ratio would then be A divided by B for each product. Quickly, what do you have there? 4032. Okay, 4032 divided by 84.
0.48.
0.48, which is 48%. Then for B, 12,432 divided by 22,400.
0.555.
0.555. Okay, so I've calculated contribution margin ratio for each product. For me to now get the composite contribution margin ratio, the composite contribution margin, let me shift. The composite contribution margin ratio would then be equal to the contribution margin ratio of product A multiplied by the proportion weighted average of product A plus the contribution margin ratio of product B multiplied by the proportion of product B. So which is equal to 0.48 multiplied by the weighted average of product A is not given, but examiner has told us that 80% of the revenue is for product B. That means 20% of the revenue will be for product A. So this one will then be 0.20, okay, plus 0.555 multiplied by 0.80. So final answer, use calculator and get me the final answer. What do you get? 0.48 multiplied by 0.2, okay, plus that should be 9.6. That's a 0.96 plus 0.555 multiplied by 0.8. What do you have? Everything add together. This should be 0. What?
Okay. The first one is
Add everything together.
0.651.
No, it can't be.
Oh, no.
0.54.
0.54
0.54. Yes.
or 54 or 54%. So the composite contribution margin ratio is 54%. Therefore, I will then come here. So here is 0.54. This is working number, I think working number 6. We got it at working number 6. Yes, working number 6. That's working number 6. Okay. Then our fixed cost is working number, reverse fixed cost, working number 5. That's working number 5. Fixed cost, working number 5. Okay. Now, so let's put everything into the formula that we have here. Let's see how it will look like. Therefore, I would then say X. Since it's X we are looking for, this revenue is what we are looking for. So it's equal to the fixed cost, 11,016, plus the profit after tax, which is 0.12 of X, divided by 1 minus tax is 0.60, okay? Or divided by composite contribution margin ratio of 0.54. So what do you have here? This will give me 11,016 plus 0.20 of X, then divide by 0.54. Okay? So, of course, you are going to multiply 0.54 of X when you cross multiply. So this one will then be equal to 0.54 of X equal to 11,016 plus 0.20 of X. Okay? So you now collect like terms. You collect like terms. So this one will be equal to 0.54 X minus 0.20 X equal to 11,016. Therefore, X is equal to 11,016 divided by 0.34. So this will give us, let me see, 11,016 divided by 0.34. That's 32,400. That's 32,400. So this is the sales revenue. 32,400, 32,400,000 is the sales revenue the company must earn. Must make for the company to be able to earn after tax profit of 12% on that revenue. So that's that. If you like, you can share this one between product A and B based on the proportion. Okay, you can share between product A and B. In this case, if I want to share it, I can then say A will be equal to 32,400 multiplied by 20% is for A equal. Then for B, 32,400 multiplied by 80%. That will give me the share of A and B multiplied by 0.2 equal 6,840.
6,480.
6,480. Then this one will be 32,400 multiplied by 0.8. 25,920. 25,920. That's it. When you add it up, that's 32,400. That's it. That's it. For number B. For number B. This number B, so that number B requirement is supposed to carry more than 5 marks. Again, examiner has given you. Lastly, number C, you have to assume all the facts in A1 to 4, A1 to 5 above. Okay, in this case, you are expected to calculate the revised break-even sales in unit for each product. That is, examiner wants you to calculate break-even points in unit for each product. Just follow the normal procedure. In this case, you follow the normal procedures using the revised estimates. So I don't need to waste time on this. Let me quickly show you how to do that. I've estimated, I underestimate the space I need for the normal. Okay, let me use this space now. So requirement number C. So calculating, examiner wants you to calculating break-even points in units for each product, taking into consideration the revised estimate. In this case, the first step, as you know, is to calculate the overall contribution margin ratio. In this case, it will be composite contribution margin ratio that we have computed, which is 0.54 or 54%. We've already done working for that, because the reason why we are calculating composite contribution margin ratio is because examiner has given us the proportion of sales value of product B. So which means that in this case, you cannot just calculate only contribution margin ratio. It has to be composite. Then number two, working number two, we are expected to calculate break-even points. Okay, break-even points in Naira. So overall break-even points in Naira, which of course it is fixed cost. Okay, fixed cost divided by the composite contribution margin ratio. So the fixed cost in the question is 11,016. That's our revised fixed cost divided by 0.54. So give it to me. What do you have here? 11,016 divided by 0.54.
2,400.
Thank you very much. 20,400,000. Okay, that's the revised break-even points in Naira. Step 3 says you should calculate sales mix. Sales mix for A and B. We already know the sales mix. The examiner has told you that 80% is attributed to product B, which is equal to 0.8. If 80% is for B, 20% is for A. Okay, 0.20. That's the sales mix. You can see it's not difficult. You just have to take yourself outside the box. You have to think outside the box. Finally, I'll just calculate break-even points. Okay, break-even points in Naira and units. If you are following Pathfinder question and answer, you struggle to understand how to get the numbers. Here I am simplifying it for you. So take time to review all what we have done. So I have the products, sales mix. All right, then break-even points in Naira, selling price, then break-even points in units. That's all. This is the last one. That's it. Somebody will say PM is difficult. It's not difficult if you understand the concepts. So A, B. All right. Our sales mix is 100. 80% is for B. 20%, sorry, 0.20. Then we want to share 20,400,000 is what we want to share. The selling price of A is 120. Selling price of B has reduced to 160. Remember, so 20% of 2,400, what do you get?
4080.
4080 divide by 120. 4080 divided by 120. Yes. 34,000 units. Okay. Yes. The other one for B.
16,320.
16,320 divided by 160.
102,000.
102,000 units. That's it. That's end of the question. That's end of the question. It's as simple as that. Right? It's as simple as that. Okay? So let me know if some of you have disappeared. Thank you for waiting behind. Kunle, Good, Ajay, Amarachi, the two Amarachi. Yes, the two Amarachi, Damilola, Evelyn is still around. Amon has been so quiet today, but he commented a few minutes ago. No worries. Ify. Stephen, are you in this class? Stephen, you don't talk in the class.
So
Stephen.
I enjoyed it. I enjoyed it.
You don't talk. That's my point.
Class.
Yeah. Victoria, Tohib, you too, you don't talk in my class. Victoria, I've not heard your voice tonight. Congress, yes, you read the question. Abubakar, you too. Yusuf, you did not talk in my class. No worry, I know what to do to you guys going forward. All of you that are quiet, I have to make you talk going forward. Okay, guys, let me know if you have any question for me so that we can close the class. Any questions so far? So if there are no further questions, take your time to review the practice for tonight. And then again, make sure you go through the concepts on CVP so that you can gain deep understanding of the topic. Once you understand it at a go, so if at all you want to go back to it in the future, it's a review. You are not going to do it as if you are doing it for the first time. All right. So just take your time, understand the concept, solve the solution, solve the question that we have treated in the class, and any additional illustration you have in the ebook. So review, then go to your Pathfinder question and answer. Just begin to practice, because the more you practice, the more you become master of the concepts. And please, guys, time is going. Time is going. We've passed 50% of the of this diet, so we have less than 9 weeks to end the diet lecture. Therefore, please, guys, you have to double your effort. Consider the money you are paying for lecture, the money you are going to pay for the exam fee and all of that. Please, this is the time for you. You have to, if you have not been reading, please, you are joking. You have to design your reading timetable. I've already told you severally in this class. You must design your reading timetable and be committed to it, because time is going. Before you know it, it will be end of September. Then you have only October to prepare yourself for the exam you have in November. Please, guys, consider all your sacrifices of Monday to Sunday, of Monday to Saturday. By this time, you are supposed to be sleeping, but you are in the class. So make your effort count. Please double your effort, and be committed to whatever you have designed in your timetable. If you say you want to read a particular subject in a day, make sure you read it, because if you don't do that, it will accumulate. It will accumulate. Don't wait till the last moment before you begin to do crashing. Crashing does not work. Crashing can make you to fail an exam. Please start reading now, so that at the end of the day, once you pass, once you succeed in your exam, then at Equity, we can then take your pride. We can take the pride. That's what we want from you. What we need from you is your success. Please, may God make it very easy for you. Good night from me to you. We'll see you next time by the grace of God. Bye-bye.
Please share the
Thank you,
solution.
sir. Exactly.
Or we can say rewatch the video and
Of
help us
course.
share the. Thank you. God bless you.
The note,
That-
yeah.
The solution, sir. Listen.
No worry, I will do just that. All right? Okay then.
Yes, sir.
Take care.
Thank
Cheers.
you, sir.
Bye.
Good night.
Good night. So if you say you muted to concentrate.